The following podcast is produced by Total Money Management AFSL 568642. Everything you're about to hear is general information and education only. It does not take into account your personal objectives, financial situation, or needs, and it is not financial advice. Before being a silly sausage and acting on anything discussed, consider whether it's right for your circumstances and speak to a licensed advisor.
Welcome back to Total Money Management. We've just me and Steve today. How are you, mate?
Yeah, good, mate. Good. How are you?
I'm good. We thought we'd get together on do a bit of a special episode.
Yep.
Really, we're going through a bit of a regime change in terms of investing. What's worked in the last 15, 20, 25 years is not really working anymore. I mean, we've spent the last 15 years in a world where you could literally almost buy anything, hold it, kind of invest into it and make money, low rates, cheap credit, with everything kind of going up. And that world's ending. And we've been saying that for a while now. Yeah. Volatility is something that started to come back a lot. So we've, in the last few episodes, we've talked about the Korean stock exchange and the volatility there.
Just on that, Korea fell 10% today.
Yeah. And oil as well.
Yeah.
7 or 8 the other day yesterday.
Yeah.
And today's Tuesday, so we're not even that long into the trading week. And so I thought we'd make an episode. Let's lay out a framework for how someone can navigate this.
Yeah.
Using some of the evidence that, you've mostly read for the last 20 years or so.
Yeah, I think what we're trying to do is we often, like you said, we often talk about this regime change, and we wrote the new normal, which said, we're going from, for example, monetary policy, right, has been the big issue for the last 25 or 30 years. Well, now it's fiscal policy. We're going from just-in-time manufacturing, where everything was really last minute, so to speak, to redundancy, where now we're going to be saying, listen, I want to have a spare 25 dishwashers, instead of making them on time. We need them spare in case the global supply chain breaks down.
So just in time to just in case.
Yeah, exactly. And so from there, I think what we're trying to get across here is under the new regime, the way you've invested for the last 20 to 30 years, like you just mentioned, is not the old, I'll just buy anything because it'll go up because interest rates are falling. We've had labour market changes, demographic changes. The globalisation is dead in the water. So that means that we've got to change our, not change our principles. What I'm trying to do here is one of the things you see over periods where markets go sideways or downwards for over an extended period of time is you see a lot of volatility, right? And what you find is lots of people only think about the stock market on the way up. So what we're doing is we're trying to give people, there's two issues where people come to struggle in down markets, right? One is that we have a bias towards the long side, right? Because markets generally go up, but they can go sideways for like 10 and 15 years, which means it's a long time where you don't make any money, right? So you've got to think, and that's where I think we're heading in the new regime. First of all, because, the Cape's at 42, but there's a whole raft of issues. Global debt, there's a lot of consumers in debt, a lot of general public are speculating in property and Bitcoin and leveraged ETFs. All of that debt has got to be paid off. And I sort of think we're heading into a scenario that looks a little bit like Japan, where you can either have a GFC-style blow-up where we get wiped out 60% in a year, or I think more likely we're going to have a Japan scenario where we basically lower the debt level, but it takes 10 or 20 years. And in that regime, asset prices basically just deflate, right? Yeah. They just fall. But they don't become good value either because they're so overpriced to start with, right? So the Cape at 42, even if you halve it to 21, that's a 50% loss, but you're still above the average.
Yeah,
right?
And almost every time it collapses to below the average as well.
Absolutely, and it goes to single digits.
Yeah, and if and when the CAPE goes back to single digits, what's that, like a 70% decline?
Yeah, that's right. So
I guess, like, from my perspective, there's lots of people that listen to us and go, well, I don't want to get into the weeds of macroeconomics. I don't want to understand. I just want to know. I just want to be told what to do.
Yeah.
Which is most people.
How can I manage my money through this?
Yeah. So they just want to know, kind of, which we'll get into. But just to frame it with you, like, people are listening to us going, I don't want to know about the global politics and things like that. So what can we give them that's easy to understand?
The investment strategy is, look, and I say this often, and we'll get into the, not necessarily the weeds, but the really simple stuff, right? When you're investing, you have to have a framework or a sort of understanding, right, of what you're doing, right?
Yeah.
So a strategy.
In your own head almost.
Yeah. So you can read about events and put them into your framework to say, as something as simple as CAPE. Yeah. Oh, the CAPE's really high. Oh, okay, I should have less stock. Oh, gee, I've made a lot of money in this market cycle. I should take some off the table. Now, you can dig in whether you want to take 20, 22, 25 or 30 or 35, but the point being is you recognise the market's expensive, right? And so because we have this bias of, we only invest when the market, or, because the market goes up, what we're saying to people is we want to give you an investment strategy that you can use through the whole cycle. So this is not, what we're talking about here is a philosophical framework, not a market timing thing, which says, hey, this is a really good thing to use when the market goes up. And when the market goes down, throw that out and we'll use another strategy. Yeah. What I'm saying here is this strategy works over the whole market.
Yes, and I think, sorry to kind of jump on top of you, but it just triggered something. Most people kind of sit in two camps, and it's time the market or time in the market. Yeah. And it doesn't have to be that black and white. You can have elements of both depending on valuation.
Yes.
But the level of knowledge generally goes that skin deep. So I guess there's, what we're trying to get across today is how do you do both in a way that's economical, that makes sense, depending on where the market is.
And it's what this is, Jacob, is it's a way of thinking, right? When the most successful investors are all really thoughtful.
Yeah.
And what I mean about that is they think deeply about markets. But if you talk to George Soros, right, Jim Simons, Stanley Druckenmiller, Warren Buffett, people who have made a lot of money over a long period of time, they just don't talk about markets. They talk about the philosophy, right, and how you deal with risk, right, how you think about time, right, those sorts of things. And so what I thought we'd do is I got this, a lot of this borrows heavily from Nassim Taleb, right, because he's written this thing he calls the Incerto, right, which is a fancy word for uncertainty. But what he's doing is he and others like Warren Buffett, Jim Simons, using the sort of Kelly Criterion married to thoughts about people like Ed Thorpe who use risk as the focus, right? And so what I'm trying to do is say to people, look, let me lay out in short terms what Taleb's thinking is, and then in the next episode, we'll talk about how you build that portfolio.
Yeah.
Right?
Well, Taleb, something we might want to explain to people, Taleb talks about coffee cups and candles and weights, and maybe, I think it's weights or weightlifting. Maybe we can get into what that means.
Yeah, absolutely.
It'd be an interesting exercise for someone to, after we've gone through it, look at their portfolio and say, okay, what's a candle? What's a coffee cup? What's a weight?
That's the way you look at it.
Yeah.
Right? So let me give you a bit of a framework. And this is straight out of Taleb's book called Antifragility, right? And it's a really great way of thinking. What he talks about is things that are fragile, right? Like you mentioned, a coffee cup, right? Now, we'll get into that a bit more. But then, so, you don't want things that are fragile, right? A coffee cup doesn't want, quote, volatility. So in other words, it doesn't want a lot of movement. It just wants to sit on the shelf. If you drop it,
it's going to break.
It's over, right? So one slip and it's over, right? You see, like he says, boxes that have fragile, what do they got in them? Glass, right? Or things that break, right? Okay, coffee cups. So the next one is robust, right? So we all know what robust is, right? It's sort of resilient, right? It doesn't mind some fragility, and it can still bounce back.
Yep.
Okay, so markets generally are robust, right? They do fall, but they do bounce back. Now, that's markets. It's not individual stocks, right? The pinnacle is being anti-fragile. And what Taleb means about that is what you talked about with weightlifting. You stress your muscles, right, which breaks them down, but then they build up bigger and stronger for the next event, right? So I'll give you 3 examples here, right? This is what Taleb uses. He uses for fragility is the sword of Damocles. In Greek mythology, that's where the sword is hanging by a thread, right? So in other words, that thread, if that thread breaks, that sword plunges down into your back, right? And you die, right? So you are fragile, right? So one bad event, it's all over Red Rover, right? Like the coffee cup, right? So what they prefer is stability, right? Coffee cup just wants to sit on the shelf, do its job, not move too much, right? And just a nice, stable environment. Robust is what I don't know if you know the mythology about the phoenix. They fly high, the wings melt, but then they reconstitute and fly again.
Yeah, the phoenix gets basically, if you've watched Harry Potter, gets old, burns up, and then rises from the ashes.
Exactly, right? So that's something...
A little bit like Woodside.
Yeah, a little bit like Woodside, right? The anti-fragile is in Greek mythology, is the Hydra. So remember the Hydra where you cut the head off and 2 heads grow back.
Yeah.
You cut those off and 4 heads grow back.
Yeah.
So in other words, you look at that, and as I said with weightlifting, you stress the muscle, which is hard in the short term, but then you continue to do it within reason, your muscles get bigger, right? So they adapt.
Yep.
And in other words, you look at that and go, actually, the volatility in my muscles and heart rate actually make me stronger, right? And so that's you want that in a portfolio.
Well, like something that always, maybe because I've just got experience, but it still kind of gets me, annoys me. Most retail investors load up on fragile investments. So
yes.
They load up on the coffee cups.
Yes.
And like small mining explorers, like something pre-revenue tech.
Yep.
And just because it's sexy and it's going to do 10,000x or whatever.
Yeah.
And but when you lay it out, it doesn't, like no one in their right mind would look at that on paper and go, yeah, I'm going to have 90%.
Yeah.
Small caps.
I'm banging in on this one.
But yet people do that.
Yeah, absolutely. That's the thing. Like if you say, okay, what's fragile? First of all, I would say individual stocks are fragile, right? Cash is not fragile, right? Because you don't lose it. It sits in the bank. You don't go back the next day and go, oh, it's all gone. Yep. But you can do that with penny mining stocks, right? Huge volatility. They don't like it and they lose value, right? So...
And all the data shows that 90% of them lose money.
Oh yeah, absolutely,
or more.
Absolutely. So as you say, you think of it like mining explorers, tech startups.
Yep.
Right. What's those other one? Biotech. Right. We've cured cancer. Oh no, we haven't. Okay, boom. That's it. They're bankrupt.
Or all the green energy stuff that.
Yeah. I got enamored with that in the mid 2000s, right? With geothermal. right? You know, and all this stuff. And I'm thinking, oh, man, this is going to
save the world.
I'm going to kill it, right? And hello, they're all going to zero, right? So they're fragile, right? Robust is where you think of something like a company that's got not a lot of growth, but is fairly sort of cyclical, right? Or sort of stable. So Woolies and Coles, right? Telstra.
Yeah.
You're never going to wake up and go, man, you know, they made 40% a year, but they'll pay a steady dividend. And if they go down, you're inclined to go, okay, well, I can buy a bit because they're not that risky.
Yeah, like too big to break.
A little bit, yeah. You're never going to wake up and have Woolworths go broke.
No.
Right? But you can wake up and have your mining stock go broke.
Well, let's talk about that for just a sec then, because let's use Commonwealth Bank. Too big to break. I would argue it's too big to break, but it's insanely overvalued.
Yes.
So how would that fit into something like that?
Okay. So that would be robust because you might buy it like now at 170 or something, which is crazy, but it will most likely get back there even if it fell to 100.
Yeah.
Right? So you're looking at it going, oh, man, I'm down 80%, but it will, if you dollar cost average into it, or if you just said I'm going to buy some more, it will survive.
Yeah.
Right? So it's a little bit like, if I can use the coffee cup analogy, fragile is the cup falls and it smashes into 100 pieces, right? Sorry, I'm just winging this bit. If the robust would be you drop the cup, you break the handle off it, but it's still, the rest of it's all right. So it turns into a mug, right?
Yeah.
And that's what I'm sort of talking about. You look at it and go, well, it's not as good as it used to be, but I can still use it over time.
Yeah, and the weight would be an ETF, something like an ETF that's never going to go broke.
Yes.
You can throw it around and it'll bounce.
Yeah. An ETF, this is the reason why we talk about ETFs a lot, because they are low risk.
Yeah.
So if and I might have said this before, if I said to you, Jacob, you've got one investment and it's to buy, Vanguard Australian shares, right? The VAS ETF, right? Now, if I said to you, Jacob, that's the only thing you can buy, right? You can buy and sell it, but I'm not letting you buy anything else. Now, what you do is you look at the chart and you go, okay, well, this thing generally over time goes up, right? Okay, that's good. But, man, there's some periods where it falls a lot.
Or goes nowhere.
Right? Or goes nowhere. But it doesn't go bankrupt. So what you do is you say to yourself, oh, okay, well, hang on. If it goes up, I should probably at some point sell some. Now, if it falls, I can buy some, and the more it falls, the more I can buy because I know it can't go bankrupt.
Yeah. So
right?
what would you
But
determine?
to finish that,
Yeah.
with a single penny mining stock, when it's falling, you go, okay, right? So do you see what I mean? That's the difference.
Yeah.
If I'm buying ETFs, I'm completely like, yep, it's cool, no worries, don't sweat it.
So one thing to shorten kind of that window a little bit, would you argue that any company is anti-fragile, or does that end at just robust or big?
Look, it's a good question. You would have to say there are some companies that have more anti-fragile characteristics, right? And let me skip ahead here since you've asked.
Oh, I've already gone to that point.
Yeah, no, that's all right. Generally, you look at, when we do sectors, right, we teach about sectors.
Yeah.
When you look at the low volatility sectors, right, energy, right, utilities, healthcare, and to a lesser extent financials, right? Now, why are they low volatility? Because you won't wake up tomorrow and go, oh, Origin Energy's gone broke and my lights have, I don't have any more electricity, right? So from that point of view, those types of companies are fairly anti-fragile. they're at the minimum robust. But the point being, when you look at a tech company, it can be here today and it can be gone in 2 weeks.
Yeah,
right?
startups.
Whereas generally the big energy companies have to be stable, right? They have to have low volatility, right? Because you can't be saying to people, oh, look, your energy, well, look, it'll probably be all right. Well, you can't do that, right? And that's where redundancy comes in, right? So that's where you look at it, and they're the ones where you say, well, if they're falling and they're cheap and they've got a low CAPE ratio, that's when you can put more in. Because first of all, under risk, you're going, okay, is I'm just trying to think of one. Exxon, right? Yep. Is Exxon likely to go broke? Probably not. Okay. Is it likely to bounce back? Yes, probably, right? Okay. So that's where you look at that, and then you can say the risk of going broke, 0. Okay. Now I'll move to my next criteria, valuation, right? Is it really cheap? Yes, it is. Oh, okay. Then I should put more into it, right? That's the way Warren Buffett thinks. Buffett says, and Ed Thorpe is the same, if there's a 1% chance of going broke, he's not interested, right? Because what he knows is, and we'll talk about this in a minute if you want, is this idea of distributions, right? If there's 1 in 100 times that it could go broke, Buffett knows that at some point it'll go broke.
Yeah, and that's a few $100 billion.
Yeah, and you tend to think, oh, well, that'll be in the next 100 years. And it's like, yeah, but that could be next year.
Yeah.
Do you see what I mean? Yeah. And that's why Buffett and Thorpe focus on not losing money. And that's why we coach that stuff.
And that's why for like us retail investors, it's why ETFs matter, because you could have 500 companies in an ETF, 10 of them go broke.
Yeah, absolutely. Well, look at the ASX, right? 20 companies fall out, 10 of them go broke, but they put in, they put new ones in. Yeah. But what you're doing is, and this is the important bit, you're betting on the whole of that economy, not just bits of it, right? So if you think with VAS, you're betting on the whole, the 300 companies, right? If you take it down a notch, you say, okay, I'm now going to invest in the financial sector. Okay. It's riskier than investing in the whole lot of Australia, right? Then the next step is saying, I'm going to invest in the financial ETF, right? The next step is saying, now I'm going to raise my risk by investing in a single financial company. Do you see what I mean?
Yeah.
The level is the fragility. Yeah. The single company, fragile. Sector ETF, robust. The whole of the economy, antifragile. Right? It will benefit, and this is why people say we need a recession, right? Why? Because we need to clean out the zombie companies and reinvigorate. Now, that's really good at the anti-fragile level, but you don't want to be a zombie you don't want to be invested in one of the zombie companies, right? Because that means you lose your dosh. But someone who's invested anti-fragile wise is saying, I don't care because I've got 299 other companies that are doing all right.
Yeah, I mean, I think you said it perfectly, where out of 100 times, or let's just use 10 times, if there's one chance of it going to 0, then there's no point. That's too fragile for
That's exactly
for a portfolio to compound over time.
Yes.
Because you're going to get that in an investing career over 30 or 40 years. You're going to get that a few times.
Yes.
And that wipes out your rate of returns.
Yes. See, that's why the importance of statistics is really, really critical in investing, because when you look at the data, about once every 10 or 15 years, you get a really big decline in the market.
Yeah.
Right? So at your age of 30, well, if you invest for 40 years, which is probably likely, you're going to see 2 to 3, probably 4 really big falls.
Yeah.
Now, that's what really crucifies your final return, because you make 100 and lose 50. Then you got to get back to 100. Then you get back to 100 and you go to 200, then you lose 50. So you go back to 100 again, right? Then you make another 100, right? Then you lose 40. Then you go back. So what you're doing is it's about it in the metaphor you used before in weightlifting. It's sort of like going to the gym, getting stronger, then injuring yourself really badly. You have to have 6 months off. You go back to the gym, you injure yourself again, right? So it's the sort of 2 steps forward, 1 step back. Yeah. Well, what do you end up with? Well, you end up with only 1 step forward, right? So what we're teaching people here is if you think in the fragility, robust, anti-fragility way, and you invest like we're going to talk about, what you're doing is you're saying, I'm not worried about the down times because my portfolio is anti-fragile and, in fact, it'll benefit, right? And that's where we've been talking about hedging, right? Hey, I don't mind if it goes down, right? So I've said this before, I hold the Korean market short, right, and have for a few months. Now, after making money on it in 25, where it went up 100%, I then swung to going short, and I don't do this all the time because it was just ridiculously overvalued. So now I'm making money on the short side.
On the volatility on the way down, and it's moving very quickly as well.
Yeah. But do you see what I mean? What I'm doing is I'm saying, well, I don't care whether the market goes up or down because I have a framework that allows me to invest where I can look at things and go, man, that's fragile. I can go short on that. Yeah. Right?
I think you mentioned it a few times. We're in a period now where being more active, it will pay off. So
absolutely, Jacob.
Active,
absolutely.
A lot more agile as well.
Yes,
and
absolutely.
Like throwing your ego in the bin and going, actually, it's really overvalued. We need to stick to
100%. Yes. And it's really, really important because the old idea is, Jacob, you're young, you just keep buying stocks. Now, my argument is, well, that's ridiculous if you know that over 10 years they're going to fall. Yeah. Right? Which means, okay, how do I make money in a falling market? Oh, okay, well, I hedge. Oh, okay, or I go, I'm going to buy anti-fragile stocks that utilities, right? Oh, I'm going to buy big anti-fragile companies that pay a dividend, right? Telcos are another one. Right, that they pay dividends. They don't grow much, but they pay great returns, right? So if you manage it through the cycle, you do fine. Yeah. But you've got to know that it's at least robust, right? Because as I say, if you go, hey, I've got a junior mining stock and it's really going up, and then it starts falling, and you think, hey, great, I can buy some more. Hey, and I can buy some more. Jesus, where's this thing going to stop, right? And then it goes to zero. Pop. Right? Yeah. That's the difference. The difference is when it's falling, like I said to you before, when it's falling, you're thinking, this is great, I can buy more. Yeah. Because you know it's not going to go bankrupt and you know enough about market cycles and anti-fragility to say, yeah, but if I keep going to the gym and, oh, God, yeah, I keep, I'm working out hard every day. It's really exhausting, but I know I'm going to get the benefit, right? And that's the same idea.
Yeah,
right?
Well, it's to use the same analogy, instead of trying to squat twice your body weight and blow your hips out and your knees, you're doing just over your body weight, and you can keep doing it for years. And you, instead of not being able to ever go to the gym again, you can go for the rest of your life and be fit and healthy.
Yeah. So it's really, really important. And as I say, the reason why we're talking about it, and I've been doing this strategy for a while because as I said, the regime has changed, right? And we're in for a period of volatility. You can't be long only because the volatility or the inflation will eat away at those returns.
Yeah. And Taleb, I think he defines it as Mediocristan versus Extremistan.
Extremistan, yeah.
I think where Mediocristan is basically where height and weight are the same thing. It barely moves the average.
Yeah. It's the normal distribution.
Yeah. And Extremistan is massive earthquake somewhere.
Yeah, the power laws. Yeah. And that's the perfect thing, right? If you look at the normal distribution, when you look at the stock market, right, you'll get good years and bad years. You'll get really good years and really bad years. And it will kind of look like a bell curve, right? Which is the same as the average male height is 175, right? I'm 175 centimetres, right? So I am bang on the average.
Bang in the middle.
People will be taller than me or shorter than me. But what I know is if I get a run where there's a lot of short people, I know that over time I'm going to get taller people to bring it back to my average, right? And so that's why I say in those types of markets, you can invest a lot of money when it's, quote, short people, right, i.e. the price is falling, because you know it's going to rise again, right? What you're talking about in Extremistan is the power law, which, as you say, is like earthquakes, right? So nothing happens and then the whole thing just blows up.
Yeah, yeah.
Right?
It'd be a good exercise for listeners to go, okay, I'll look at my portfolio. How many companies are overvalued and living in Extremistan?
Yeah.
Or is my super just in the S&P 500 and living in Extremistan? So it's not just the individual stocks right now. It's most super funds are invested in America, which is overvalued.
Well, that's right. You see, you look at your portfolio and you go, how fragile am I? And you can walk through it and say, oh, look, I've got 5 tech stocks. They've done really, really well, but they're batshit crazy overvalued. Oh, okay, they're fragile, right? Oh, but I've anchored that with, not US stocks, but maybe, Brazil and Turkey that are really cheap and they will probably go up over time. Yeah. Oh, cool, right? So as you say, you go through your portfolio and look at it and say, is it fragile, right? Is it robust? Think, if you're thinking fragile, you might think of, as you said, like junior mining stocks, right? Or companies that have got a lot of debt, right? Robust might be someone like Woodside, right? It's cyclical. We talked about it when it was cheap.
It's been around forever.
It's been around. It will continue to pay a dividend. It's got a product everybody uses. All right, it might fluctuate, but you still feel confident buying it on a relatively cheap basis, right? And the last thing is the market itself, right, is anti-fragile. And that's why I say if you too many people talk about diversification without talking about correlation, right? And what we know is when the CAPE is really high like it is, the correlation between the US and the rest of the world is really strong. Yeah. So even though we've been talking about emerging markets because they're cheap, it doesn't mean they can't go down further.
It's still pegged to the US.
Yes. So they might get cheaper, but you've got to be aware of that to say, okay, I'm not in a Brazilian junior copper explorer. Yeah. Then you're asking for trouble, right? Yeah. So where a lot of junior miners go broke is in capital raising, and part of the problem is they need 500 million, right? So they might raise 100 at a time at 100 million, but then we get the GFC and banks go, dude, we're not lending to anybody. That's when the mine goes, okay, we've got to shutter this mine until we can get it. Or what we do get is you get Rio Tinto comes in and says, hey,
I'll buy it for
we'll buy it for 70 million, right? You blokes can go and live in the Bahamas and we've got a locked up asset, right? So again, Buffett is making himself anti-fragile because he's been selling for the last 3 years. So he's got 400 billion in cash. He's got really great companies, right, that will last out the next 30 to 40 years. And if they get cheaper, Buffett is able to say, this is fantastic, right, because he can buy more.
Yeah, and it doesn't mean he can't get a bit speculative. It just means the distribution of capital to your investments is not 80% weighted to speckies.
Yes.
It's the other way around.
Yeah, that's what Buffett Taleb talks about the barbell portfolio, right? He argues 90% in bonds and 10% in speculators, right? I think that's a bit excessive, but my argument is, and this is why I say, the stock market is not risky, right? You'd have to... individual companies are risky.
Yeah.
Right? But the stock market as a whole relates to or reflects like a normal distribution. And from that point of view, yes, it can go down 50%. Yes, it can go down 70%, but it will survive.
Yeah.
Whereas a junior miner a biotech or something like that, it can go down 80% and go, the show's over, guys.
I just think without getting into like this, but the introduction to the stock market is now getting or access, I guess, is easier.
Yes.
Now than it ever was, and people are getting introduced to the stock market from other people. It's the herd effect that have done really well. No one's going to walk down the street and go, "Oh man, I've just lost all my money." But you should get into the stock market.
Yeah.
It's people going, "I've just made all this cash."
Yeah.
It's the same with property.
That's why property investors now are starting to look at it, and they should be thinking about how, they say exposed, right? But you've got to look at it and say, how fragile am I? And this is where you get things such as your partner or you lose a job.
Yep.
Right? You automatically go, actually, we're not as robust as we thought we were. Right? And that's the issue. Right? You don't get killed by being anti-fragile. No. You get into a world of pain when you're fragile. And what builds fragility or what makes fragility is a lot of inexperience, right? And this is why, young fellas buy Bitcoin at 140, right? And they get taught a lesson, right? Because they don't have the experience, but above and beyond that, they don't have a framework where they go, am I taking a lot of risk? Absolutely. Okay, I need to be really careful.
Yeah.
What does that mean? It means selling when I've made a bit of money.
Yeah, like looking at it, we'll use Aussie property because it's the only thing people kind of register, is they've done really well over 10 years. And even this week, we've had probably 7 or 8 people reach out and go, "Hey, I'm thinking about selling. What do I do? How do I be less fragile?"
Yeah.
So it's happening, and that's just us. So I can imagine that most people with property, especially over the last 5 or 10 years, are now thinking, is this the right place to be?
Absolutely. That's what I mean, Jacob. Look, when the market's going up, it's really easy to get complacent, right? Hey, things are fine, it's going up. But again, if you think of it in the sort of Damocles way, you sort of think, yeah, things are great. You look towards the ceiling and you go, Jesus, that thing's just been held on by a thread.
Yeah.
Right? That's when you go, I need to think about what I'm doing here.
Yeah. And the result's not just a knock on the head, it's you're dead.
Absolutely. Right? It's the coffee cup.
Yeah.
Right? So that's the way, if you position your portfolio like that, and in the second edition, or what we'll do is talk about more of the solution, so to speak, right? Things like, Taleb talks about the philosopher's stone and that sort of stuff.
So next week we'll talk about anti-fragile portfolio construction.
Yes.
We'll go through Taleb's philosopher's stone, not Harry Potter's philosopher's stone.
Yeah. Please don't get it confused, folks. Come around, kids. Steve and Jacob are going to talk about the philosopher's stone. What is this garbage? Yeah.
And in the meantime, between this week and next week, for listeners, if you have questions around your portfolio and how it's structured, please reach out. We're happy to answer some questions as always. Anything else you want to cover?
No, I think that's enough for one lesson, as they say.
Thank you. Cheers.
Cheers, mate.
See you next week.
Cheers, folks.
You've been listening to Signals and Noise from Total Money Management AFSL 568642. This episode was general information and education only, not financial advice. It did not consider your personal objectives, financial situation, or needs. Any stocks, markets, or strategies mentioned were for illustration, not a recommendation to buy or sell. Past performance is not a reliable indicator of future performance. Consider your own circumstances and seek advice from a licensed advisor before making investment decisions.